Today I wanted to talk about how stocks move in the stock market. So, a lot of people jump into trading, think, oh, I'm going to make some quick money or it's going to be easy, and they don't really understand what the stock market is and how it moves. So, my goal today is to show you why stocks move and how they move as well on the chart. So, let's get started on the whiteboard. So, let's say we have a startup and let's call it Connor's Waffles. So let's say I've been operating this business for a little bit, and let's say that my company's worth $1 million. And we're going to say that I own 30%. My business partner owns 30%. And then there's 40% left that we're going to use for investors. So we're going to use it to make money. So let's draw out the ownership of this company. Let's say this is the entire ownership, and it's split up into, let's see, I own 30%, and then my partner owns 30%, and then let's say there's 40% left for raising money. So what I can do is I can do what's called going public. What that means is that, so I own 30% of this company. I have the rights to 30% of the profits. Same with my partner. That 40% we purposely left blank so that other people could come in and buy pieces of our company so that they could have the rights to some of the profits and also have voting rights to be able to vote on what we do. So eventually this will be broken down into tiny little pieces when we go public, and yeah, I guess I drew them big, but really they're going to be smaller because a lot of times companies will have a lot of what are called shares of stock. So this is the company's stock. It's just little pieces of ownership of the company. And these little pieces right here are called shares. And I'm not going to draw all the shares because there's usually a lot of shares. So let's say my company is worth $1 million and I have 100,000 shares. So just imagine this grid being really, really, really tiny, tons and tons of shares. And when we go public to raise money, since we set aside this 40%, this whole thing right here, this goes to the public to buy and to sell. So now all shares, after we go public, all shares are owned. And I own 30%, my partner owns 30%, and the public owns 40%. Now these shares have to be owned by somebody at all times, which means that you can't sell a share to nobody. It's not going to disappear. All the shares always exist in the stock. So we're going to talk about now price changes in the stock. So my company is worth $1 million. Let's say after a year, it's then worth $2 million. So we still have 100,000 shares of stock, but the stock is now worth $20 instead of $10 each. So if we have 100,000 shares, a million divided by 100,000 is $10. And let's say after a year, our stock or our company increases to 2 million valuation, then the shares are $20. So these shares have increased in value, which means that whoever bought the shares last year at $10 they've effectively doubled their money. And now they can take their profits by selling this to somebody else. So that price change happened because the company got better. Maybe I opened up a new location or a few. Maybe I got a new efficient way to make waffles or a more efficient formula. Maybe more people are visiting and we're making more sales. Either way, the company's now worth $20. So that's what we talk about when we talk about investing in stocks, is we're buying a little piece of a company or multiple pieces, and we're expecting the company to get better over time and people to value it higher over time, so that now it's worth $20. So let's talk about exactly how those price changes happen. So when all of the shares of stock are owned, let's say they're all owned, and let's say 3 buyers come in. These 3 buyers want to buy stock, but remember, the stock, there's no stock to buy, right? All of these are owned by some person. And so if these people want to buy, somebody has to sell to them. So since there are 3 extra buyers, there has to be 3 sellers. Now the only way to get somebody to sell a stock when there are buyers is for the price to increase. Because these people aren't going to sell if the price is going to stay the same. The price could also go down to get you to sell, but the point is, since there's more buyers than sellers, 0, the price goes up until the buyers equals the number of sellers. So the stock, we said it was worth $2 million the second year, so let's say the stock is worth $20. And there are 3 buyers and 0 sellers. So we need to match the amount of sellers to buyers. So the price goes up to 20.01, 02, 03. Oh, let's say we've got a seller that's selling at 03 now. Maybe they bought it when it was $10 and they're ready to sell. So let's say one person comes in and sells. Now this person is buying from this person, and so they cancel out and the stocks are all owned. There's 2 more buyers here, so maybe the price keeps going up to 05, 07, so 2007, and then we have another seller, someone who's willing to sell for that price. So now that person sells to the buyer, and we've got 1 buyer left. And then it goes up to, let's say, $20.10, and then someone's willing to sell their stock because it's gone up enough. These cancel out, and now nobody's buying or selling, and the stock price is priced at $20.10. So maybe another thing that happens is stocks often go up in value and then they go back down. Then they go up and then they go down. Good companies tend to go up in the long term, and not so great companies that aren't really growing tend to go down in the long term. But almost always a stock is going up and down in what we call the trend. It could be trending up, the company's getting better. It could be trending down, the company's getting worse. But a lot of times when the stock increases, right, it's at 2010. And so maybe that didn't just attract 1 seller, but attracted 2 more sellers. So let's say we have 2 more sellers here. These are people that want to sell the stock. Now there's no more buyers. So what's going to happen to get more buyers is the price is going to have to go down to a point where people think it's worth it to buy it. So then what happens, maybe since there's 2 sellers, is in order to get 2 buyers, the price might have to go down to, I don't know, let's just say $20.04. And then we get 2 buyers. And then the sellers sell to the buyers, and it cancels out again. So now it's at 20.04. So we started at 20, we went up, we went down, and let's say now we attract a lot more buyers at this price because the company's getting better. Then there will be more buyers, and then a few sellers, more buyers and a few sellers, and the stock will continue up. So stocks don't go straight up forever, and they don't go straight down forever. They often do a trend like this. And what that means for investors is you can't expect a stock to just shoot up right away by like $10 unless there's a huge hype around it or something really, really good happened to the stock. And at the same time, a lot of people, they overreact. So what happens is there will be a news coming out and people will go, oh my gosh, that's so awesome, and there's so many buyers. And then we run out of buyers. And then whoever bought down here ends up selling and selling and selling. So a lot of times there's overreactions in the stock market. So investors like to wait for the long term. And there's something called stock traders. And stock traders try to catch these little, like they'll buy here and they'll sell here and then they'll wait. And then they'll buy here and then they'll sell here. And so if you were an investor taking, let's say, $20 and turning it into $30, you would get a net profit of $10. But a trader could buy here, sell here for, I don't know, what would that be, like $4? Buy here, sell here for another $4, buy here, sell here for another $4, and another $4. And instead of netting $10, they've just netted $16. So traders try to profit off of short-term movements in the price, which means they need to know when buyers are coming in and when sellers are coming in. And something they can look for is like news happening with the company. Oh, the shares are going to go up and then they might go down a little bit more. And so they use strategies like this to catch these short-term profits in the stock and make more money. Hopefully that video was helpful for you guys. If you did learn anything, leave a comment about what you learned. If this was useful to you, go ahead and like this video and subscribe if you want to see more trading videos. Thanks for watching, everyone.